official FOMC live stream. That's right, we created it. We are the originators of the hype around the FOMC live. And today we join each other to watch a doubleheader, not just the FOMC, which is going to be the biggest, most exciting, most important one of your life, of course. Like, aren't they all? But also the 180-day presidential crypto review is set to be published. We're going to get into this more later. Set to be published during the FOMC meeting, or about 2:30 exactly when Chair Powell speaks. We'll find out. So I appreciate you tuning in today. Here's what we're going to do. We're going to go over a schedule of the events that are going to take place today. I'm going to give you my brief overview, which is going to touch on the impacts, the likely outcomes, the data. Yes, right, we have the data that you should know. What has changed since the last meeting and what the Fed is looking at that is likely to impact their decision today. Then we are going to review the statements from the last FOMC. We're going to watch Chair Powell's key intro note, and that's going to give us a basis point to compare or judge or kind of gauge what we hear today, because as you know, they do tend to sound very similar, but the subtle changes in language are the important parts that can send markets moving. Chair Powell, the interest rate decision will publish at 2 p.m., so we have under half an hour until that comes out. Chair Powell himself will speak at 2:30, and then after that, we're going to listen to questions from the press and pray that Greenah, Asian Gina, or maybe even OG Gina, rejoins us and ask some questions there after the post live. So here's what I need from you guys. Hit that like button, subscribe, join our fam. It's going to be a fun day. It's going to be spicy. A lot of the time people think nothing happens at these, but I promise you, based on the culmination of the FOMC and this crypto bill coming in, we're going to see some spiciness. Markets are going to react. It's going to be worth watching. So continue to hype up the chat. Hit the likes, subscribe, say hello, and let me try to get through. I did a lot of homework. For you. As you can see up here on the board, we have on the chart when the rate will be published. That's 2. Powell speaks at 2:30. We're going to be watching these charts. We have Bitcoin and the S&P pulled up right here. We'll probably pull up the Dixie and a few others as we get into it. But let me jump into what we're looking at today. So the last month, and let's be real, the last multiple months have been very interesting for Powell. Public sentiment on Powell has soured in many directions. It's been interesting. He's been called all kinds of names. He's been kind of thrown left and right and under the bus, and so much so that Trump himself paid him a visit. And we did watch this, but honestly, this is like truly one of my favorite clips ever. So let's just really quickly rehash what happened just last week.
Well, thank you very much. We're looking at the construction, and we're with the chairman, as you know. Chairman, come on over. And we're just taking a look at what's happening. You know, it's a tough construction job. They're building basements where they didn't exist or expanding them, and a lot of very expensive work. There's no question about it. And Tim has been with me for a long time, and you're in charge of the committee.
Indeed. One of the reasons why we wanted to see it was the overruns of the expenses. We wanted to figure out why.
Yeah. So we're taking a look, and it looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
It just came out.
I haven't heard that from anybody at the Fed.
Yeah, it just came out.
You heard it.
Our notes had it about 3.1 as well.
3.1,
3.2.
This came from us?
Yes. I don't know who does that.
You're including the Martin renovation. You just added.
That's our entire capital plan.
Yeah, you just added in a third building is what that is. That's a third building,
Well,
including
no,
the
but
Martin building.
it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But it's
So,
not new.
So we're going to take a look. We're going to see what's happening, and it's got a long way. Do you expect any more additional cost overruns?
Don't expect them. We're ready for them, but we have a little bit of a reserve that we may use, but no, we don't. Expect to be finished in 2027. We're well along, as you can see.
Nice to take these off every once in a while when we're not under too much danger. So, any questions?
Mr. President, does the issue give you
as a real estate developer, what would you do with a project?
Yeah, we're not going to listen to those questions. Truly meme-worthy. Honestly, my favorite clip ever of Trump and Powell. The look on Powell's face, man, he just, priceless. Absolutely priceless. My first thought was that was AI. Nothing about it seems real. Doesn't the whole thing just seem out of the norm and surreal, like to you guys? Maybe it's just me. So during this meeting, because clearly that was not the entire talk they had, Trump met with Powell, I think it was for a few hours, and they walked around. That was just kind of the press highlight. What do you guys think? Do you think that those talks were productive? Do you think that they had a meaningful conversation? Do you think that they maybe came to any kind of agreements or conclusions? Do you think that that will impact what happens today in the FOMC? Let me know in the chat. I want to know your thoughts. I'm not going to speculate on that one, but let me know. So let's jump into today's meeting. And the other market, we'll talk about the other massive event happening today. The 180-day crypto report coming out by the president. Interesting timing. Seems impossible that these things were accidentally timed on top of each other, but this is really not out of the norm for Trump. We see him speak pretty frequently when Powell is center stage. So today, that could end up being spicier than the FOMC itself. That's right. So today, what we're really looking at, what's coming up next. So let's bring this to our center attention. FOMC, I think I have to refresh this, is actually in 18 minutes, we'll have the interest rate decision. As it stands, there is a 97.9% chance, according to investing.com. And you'll see as we get further into this kind of breakdown of what's happening, also by CME Watch, that virtually no chance of a rate cut today. 2.1% looking at 25 BPS, and that's pretty much what we have been seeing week over week. Markets are not really looking for a cut. In fact, I would say that the Fed is overwhelmingly expected to keep rates steady today at 4.25 to 4.5%. And they have been there since December 2024, so since last year. Our coverage on investing.com and CME FedWatch show about 95% chance of no change. And this is what we've been saying on this channel for months and what seems like maybe all year. In my mind, September is the likely target for the first cut. Now, a lot of people are saying, oh, the Fed isn't going to do it. They don't like Trump. They're not going to do it. Honestly, I think the Fed's just going to stay on schedule for what they said. The Fed kind of hinted or indicated at these cuts earlier in the year and kind of, in my opinion, gave the impression that they would happen further down the line. And September still remains that likely target for the first cut. When we look back at the previous FOMCs, we have seen the dot plot come into play, and that is where the voting members of the FOMC place their little dots on a graph of where they see interest rates in the short term, next year, year after that, and late future. And that indicated that there was a majority looking for 2 cuts this year. This is the important part, including today. So including in just 17 minutes, we only have 4. So after today, 3 left in the year. If we were to have 2 cuts over these 4 times, basically if there's no cut today, that would mean that almost every single meeting between now and the end of the year, we should expect a cut. Things are always subject to change, different market conditions, but that's what we're seeing, and that's been pretty consistent throughout the year. So a lot of people also are thinking, why would the Fed hold rates? Well, recent data does indicate solid economic growth, low unemployment, and in fact, even today, we got a robust 3% Q2 GDP growth, which Trump tweeted about and talked about cutting rates again with it. Those are all good signals. Inflation does remain a little bit above the 2%, and unfortunately, all of those things combined really show little need for a cut. I don't even know why I'm saying unfortunately. They show little need for a cut. Now, of course, there are potentially factors coming into play. Tariffs, people have the expectation of pushing prices higher. And really what we have to see is the majority of tariffs haven't even come into play yet. They have been extended, kind of the unilateral across the board tariffs were pushed back to August 1st. So they haven't even gone into effect yet. So there's no way to know what impact those will have. And that's going to add caution to the Fed. They are unlikely to really move. And it's interesting, Fed August 1st and then September, timing really works out. They're unlikely to move quickly without seeing or having a good picture of what that looks like. The Fed will continue to emphasize its independence and its data-driven approach, which I think what you have to say is they stick by the data-driven approach and independence. You just might not like the way they do the data. You might not like the calculations. And I would agree. I think CPI, CPE are bullshit metrics. I don't think they're reflective of true inflation or what the average American is experiencing, but they do kind of stick to their formulas. They look at these formulas and say inflation is this or that or good or bad or whatever, and they do stick to that for the most part. They're, I would say, like an equation-driven approach. So today, the most important things that we are going to be watching for. Obviously, we could get a curveball. We have a poll going in the chat. Please vote in the poll what you think is going to happen today. The final option there is wild curveball. And of course, that's always possible. But let's focus on what is very probable. And that is going to be Powell's tone. We talk about this a lot. Powell's tie. No, I'm just kidding. Powell's tone also is tie. But his tone, we talked about this a lot. This is a tool that is referenced as a forward guidance. Forward guidance, letting kind of the markets know what the Fed's looking at, maybe without saying we're going to do X, Y, Z by, this date. And they say they'll use things kind of like in a hinting way. They play a little game. For instance, you may hear the term progress on inflation. That could boost markets. Progress on inflation could be their little subtle way of saying that inflation, they see inflation being quelled consistently over time. We may see them make hawkish comments like inflation is sticky. Both of these we've actually heard, I believe, over the last year or two. That might temper expectations. We're really going to try to read into his language, his energy, the way confidence, the way he says words. His word choice specifically is going to be highlighted here. There are some experts that are noting there is internal FOMC dissent, and that is true. We've seen different FOMC members kind of come out and make statements saying that they think it's time for cuts. There is a division. Remember, this is a voting board. Chair Powell does not just make the decisions. He doesn't just say cut or no cut. It is, I believe, it's like 13 voting members. And so to see dissent means that there isn't a consensus, which can show some weakness in their collusion and their decision making, or that there is maybe unexpected things on the horizon. I don't know. Either way, markets are pricing in 1 to 2 rate cuts by the end of the year, as we said, potentially totaling anywhere from 50 to 75 BPS. I think it's on the 50 side, but neither here nor there. Since the last meeting, we have gotten some key economic data, and we should review that because this is going to be important context going into the meeting. CPI inflation ticked up slightly from May's 2.4% headline, but monthly increases were modest and core remained sticky above target. Really not huge. These aren't huge, but it was uncomfortable to see that little tick up. CPE, and I believe this is the preferred metric over CPI. We hear about CPI, but I think CPAE has been said by Chair Powell to be their favored metric, is closer to that 2% target than CPI. June's data released post-meeting on the 31st showed cooling trends supporting eventual cuts. I think people get the impression that the Fed is against all cutting. Always. They're not. I missed a part that's important. Maybe I'll circle back. Well, we're in the middle of this. So unemployment, we're at near full employment. That's the Fed's estimate of 4 to 4.2%. So this number is basically perfectly in line with what the Fed looks for. Solid, but slowing job gains. I think actually job numbers came out that aren't included in this. Could prompt future easing if some more weakness emerges, but it is basically where they want it to be. GDP just came out stronger than expected. That shows reduced urgency for cuts. It's interesting to say, look at this huge growth, look at these big numbers, now cut. That's kind of the opposite. while I don't expect the Fed to hike at this point, unless something crazy happens August, September, I won't even comment on how, but unless something crazy happens, I don't expect them to hike. But to say, look at how great the economy, look at it, stocks are at all-time high, Bitcoin's at all-time high, assets across the board are at all-time high. They're in price exploration. They're moving higher. We're in a bull market. Look at our growth. Those are the opposite of arguments to cut. If anything, you would say they're arguments that you could raise them higher, that maybe they're not high enough. I'm not making that argument, but in the Fed's eyes, strength is not. You look for weakness. You look at you want basically weakness for cuts, like inflation. Other kind of stats out there. So those are the main ones they look at. But the other kind of stats, consumer spending has been pretty flat. People are worried about tariff inflationary pressures, to be determined, in my opinion. July jobs report, August 1st post-meeting, looking for September's outlook. I don't even know what I wrote there. So implications of what could happen today. The likely outcome is that rates hold steady. Markets may dip short term if there's no further signals of cutting, if there's no kind of forward guidance of, hey, nudge, nudge, we're looking for this in the short term. We could see the opposite. If there are hints of easing, none today, but hints of cuts coming in September, we may see markets begin to maybe perform a short-term rally. They're already rallying, but gold and bonds may benefit from dovish talk, and the dollar could strengthen on caution. Basically, that's what we're looking at realistically today. The risks, a surprise cut. Now, this is very unlikely, but I would consider this a risk. This could signal economic worries. If the Fed all of a sudden decided to cut today, it could be an economic worry. I don't believe that they have data that would support that, but we're talking about the outliers here. Economic worries boosting risk assets like crypto and stock. Yeah, sure. Persistent inflation or tariff talks could delay cuts into 2026. That is on the table, but we would have to really get some forward guidance there that pushes us in that direction. Basically, my tip for you all today is focus on Powell's Q&A for nuanced phrases. As we went over earlier, that forward guidance, confident in disinflation, vigilant on risks. These words can move markets, and that's why we watch them. The Fed overall acts gradually, and so to expect big shocks today is probably not the best bet. So what do we got? We got 8 minutes. 8 minutes. Dang, that was good. I was worried I wouldn't even be able to get that all in. I actually have another section. We got more content for you. Don't worry, we're not done. In 8 minutes, we are going to see the interest rate published live. We have a little tradition here. If you'd like to pull up a tab right now, open up your favorite search engine and get ready. As soon as the clock strikes 2 p.m. Eastern time, that interest rate decision will be published to news outlets, and we do a little ritual of trying to be the first one to put it in chat. So we got a few minutes here where you can prepare whatever kind of question, whatever sources you want to look at. I'm going to use cryptocraft.com, and just cheap and easy. But we like to put that first. Make sure you put in the change or no change, but include your source. Don't just say no cut. You got to include the source. Sources need to be included. If you don't include the source, it doesn't count. Let me see. Do I have time? So I'm balancing this. I'm balancing what I want to like jam after the interest rate decision. I think I'll wait. I'm going to go over what we know about the crypto report. I'm going to do that actually. We'll do that right after the interest rate decision's in. I don't want to get sidetracked and miss it. I think that's fair. After the interest rate decision is in and we have 30 minutes till Chairman Powell speaks, we're going to go over that previous FOMC statement. That way we'll have it fresh in our minds. We'll be able to compare it to what Powell says today, and we'll see how it differs. I have the transcript pulled up. We're not going to read it because, my Lord, this would be boring. We're not going to read it. But I have it pulled up, and I'm going to be watching it. And be watching it as Chairman Powell speaks. I'm going to be looking for discrepancies, changed lines, changed word choice, and I'll be updating you on that as we go. Hell yeah, we did all the homework today. Let me pull up the chat. We got a few minutes here. 2,700 live viewers right now. Not our biggest FOMC. I'm surprised because this is the biggest, most important one of your lifetime. We did a really good intro. Surprised. If you're here right now, Say hello. Pull up the gold chart. We'll throw up the gold chart. We can throw up gold and we can throw up the dollar. They're both going to be important. If you're here today, put something in the chat. Let me know. What's up, boys? If you haven't liked the stream yet, smash that like button. If you haven't subscribed, join our fam. What's up, boys? DJ Ricochet, EMAC. What's up, man? Ryan Monkey. How is everybody? How's everybody feeling today? How you doing? Do you get the energy? Do you feel the energy? I feel it. I'm going to gift. I think I've sent all the free gifts, memberships. I'm going to send some more. I'm going to launch out some membies right now. We got a few minutes to kill. Make sure you subscribe, hit the like button, say hello. We're going to launch out these gift memberships. Get some emojis. They don't really come with anything, but you'll get some emojis to use. Yeah, get some emojis to use while we're live. Throw those. If you get a membership, if you get gifted one here, I ask that you put a little chirpow emoji in the chat. That's all I ask. FOMC vibes, baby. Let's go. Let's go. Who do we have here? Just 5 minutes until the interest rate decision is in. And then Chairman will be speaking. What's up, Crypto Mike, Am Cash, Aaron Wright Art, Ace of Hearts is going to be hard. There's a lot of names. Ahmed, Alexander G, Big Don 25. What's up, Alex CH? How you doing? Bobber Scout Crypto, Boss Mac, Brian McAllister, Bullish Mike, Bullish Future. What up? Arpad, I see you, bro. Anitis, Simokaitis, I butchered that. Ahmed, Brian, BX Dolph, Bon Su Kem, CK, Captain, Jay Graybeard. What's up, brother? Carlos Lopez, Cassius, how are you, bro? Good to see you, my friend. Caesar, Chris Twirbut, Coins Chick, a rare Coins Chick sighting. Coca-Cola, Kobe, Neeson, Conlon, Kifney Media, Crypto Economia, Crypto 420. Blaze it, boys. Let's get 420 likes. If we don't have 420 likes right now, we can do that in this moment, and it is embarrassing, and there's no excuse. Hit the buttons. Crypto Independent, Crypto Mel, Crypto Agent 007, Crypto Ace, Crypto Freddy, Crypto Mania, Crypto Steve-O, DG Darren, Derek Merrill, David Perry, Discipline and Focus, DJ Monty, D-Lo Brown, Donkey Dan, Dre, Dude TBG, Echo Leaf, EJCP, F1 Inferno, Fiber Splice, Folsom, Foxy Thorny, Frank, Cole, Gowd, Georgia Vol, Harry Hood, Henny Britton, Hip Hop, 100 Air, So King Degen, almost got me. In Code We Trust, Janix, Jasper, Jay Trader, Jimmy G, Josh Kennington, JP Brummer, Justin Grover. We have so many people here. Keep them coming. Keep them coming. If you haven't said hello yet, say hello. Put some in the chat. Karen, how you doing, Karen? Keyman, King Peasant, King Andrew 900, Craig Crunk, League of Legends Prime, Leo Marker, Leonard, Line in My Pocket, Loading Name, Madness Worldview, Magnus Larson, Muhammad Rafiq, good to see you, Magnus, Mahmud, Marshmallow, Matt, Mekokek, Mems. They pull us up, you can even see what I'm reading. Me Paradis, Miller, Michuana, Mikey, Miran, Halovic, Mr. Bobby Fresh, Mr. Techno Goody, Nate Bender, Nate Dog, Navman, Nicholas Perry, Nikki Page, Nomadic Life, Oculus L, Pablo Jr., Parker, Angie, Patrick, Ugolini, Patriot Caveman, Pawuzavs, I'm losing them. Peter Provost. Oh God, there's so many. There's so many, boys. I'd love to see it. Chirpow. Philly Skills. What's up, my friend? Freak, Pranav, Riker's Beard, Rad Crypto. So many. Raymond Flores, Raven Ravenson, Retro Beast, Rigo, RR, Toro, Santiago, Sentence to Life, SES, Shane, Shannon Carter, Sierra, Sinister, Smokesar, Softshell, Stairway B, Stan's Panic, Pendulum, Stephen Watson, T-Bone, Taco the Duck, 10 Pence, Pickle, The Bearded Wanderer, Thuvids, Tillin McBooch, Tillin Kingsley, Timmy Lee, Token Trekker, Tom G, myself, Tom Lumen, Tor, Trade Mill, Trust Your Strength, Twiggy, UFO Nut, Up and Run, Van D. Hayes, Verhoofty, Floofen, Victor, Porez, Victor, Lopez, Vlad, Daskalu, Voxy's Token, Wefa 9, Wick, XRP Goat, XXGD, Yellow, Leb, Gix, Yogi, Leslie Snipes, Yowat, Zuluki, BTC, Palm Beach, and bro, I probably missed 1,000 more. Holy shit. Welcome, every single one of you. Every single one of you. And look at that. I finished the roll call with seconds to spare. Just seconds. Literally seconds to spare. Pull up your tabs. Start Googling. Because the interest rate decision is coming in hot. It's coming in hot right now, 39 seconds. Be the first one to put it in chat, and you win all of the honor, all of the good honors today. I'm going to zoom in. We'll pull gold and dollar back in just a second. I probably want dollar more than SPX right here. We love watching those candles roll over. We love watching them roll over. There have been big candles actually the last few FOMCs. I want to say the last one was like maybe the least explosive, but it was still explosive nonetheless. Reminder, be careful trading today. These are highly volatile events. Please practice safe risk management. Here we go. No cut. I'm seeing no cut, but I'm not seeing sources. No change. Put a source. You got to put a source, boys. Got to put a source. On them all. Pokemon. What up? All-time high Bitcoin taking off here, and stocks juicing. Forex Factory 4.5 no cut. All right. I think no cut it is. Looks like Bitcoin's juicing on this. Nice little poppy candle here. We are very zoomed in, boys and girls. Please don't think you're missing the moonshot yet. Very zoomed in. What do we see? Dollar taking the L here, while gold, stocks, and Bitcoin all firing up. Nice little gains, 0.1%, and we're talking in seconds. Looks like stocks and Bitcoin up about 1.5% in seconds. The dollar taking a little bit of a move to the downside here. Now, we commonly will see this move reverse by the time Chairman Powell speaks, but it's getting really spicy. By the way, mods, don't time anyone out. Let people spam today. Don't only remove stuff that's like real bad. Don't just let people be crazy today. Spam it up. How do you feel? What do you think is going to happen next? Spam it up, boys. I want to know. We got more to cover here. I have so much to cover. Powell, a 500 BPS cut? 500? Cutting it all the way down to zero? Dude, I don't even know what would happen to markets. I feel like markets would explode. They would just like absolutely, positively implode. Okay, let's shift focus because, wow, now we're seeing Bitcoin take a little dump. I don't know if I can shift focus yet. Bitcoin and stocks rallying in the initial 60 seconds of the interest rate decision, now retracing that entire move. The dollar showing signals of reversing here, but not quite following through. Really just seeing kind of a drain on the markets. Gold retracing, less than stocks and Bitcoin. Wow, interesting. I'm going to move the dollar up. Hold up here. Move to visual. What? Uh-oh. Dump-a-roon. Are we getting a dump-a-rooney move chart back? There we go. We're getting a dump-a-roon. Oh, no. Oh, no. Oh, no. The dollar rebouncing while Bitcoin gave back all of the gains it made in the initial 60 seconds. Now seeking lower. Not what we wanted to see. So let's talk about it. While we watch the chaos unfold in front of us, make sure you're smashing that like and subscribing, being careful with your trades today. But let's shift focus here to the crypto report. And then we're going to get into the previous FOMC statement. So the crypto report, there is a 180-day crypto report officially titled The Report from the President's Working Group on Digital Assets. This is aimed to be a comprehensive policy framework that was mandated by the president via Executive Order 1417-8 and signed on January 23rd of this year. This order aimed to strengthen the U.S.'s leadership in digital financial technology, and it required a review of digital asset regulations, innovations, and risks. The report's completion today marks the end of that 180-day timeline. There was a slight delay from the original 22 target. I don't know why. And it is set for public release literally today amid high anticipation from the crypto community for potential market moving details. Hilariously, this is rumored, because a lot of this is not official yet, but it is rumored to be published at 2:30. So in 26 minutes, exactly when the FOMC starts. Coincidence? I don't know. The scope of this report is to provide clarity. Our favorite thing we love hearing, but we rarely ever get clarity. To provide clarity, including token classifications, security versus commodities, which I believe we did have some resolution already on this month, maybe. But they said they were providing clarity to resolve the jurisdictional issue between the SEC and CFTC. It addresses stablecoin reforms, such as 100% cash T-bill backing requirements, licensing, and oversight to enhance stability and consumer protection. You know, actually, while I do this, I think I should pull up the White House release. White House release. Let's see. Didn't release yet. Okay, I'll be watching now. It covers custody rules. It should define legal custodians for digital assets with new auditing and reserve standards for institutions and government-held crypto, like the Bitcoin Strategic Reserve and the crypto stockpile. It discusses CBDCs. It likely is to express criticism towards a programmable dollar while emphasizing competition with global rivals like China's digital yuan. Includes banking access reforms, national security considerations, and technology-neutral guidelines for crypto firms. Emphasizes tokenization, utility, and innovation support, aligning with recent laws like the Genius Act, Stablecoin Regulation, and Clarity Act. To this moment, there is no mention of the Bitcoin Strategic Reserve in the report. Now, the report is not live yet. Womp womp. But there's no mention of the Bitcoin Strategic Reserve. Reality is this. We're just going to have to wait for it to be published. It's supposed to be today. I believe Trump is actually speaking at 4 p.m. today after the FOMC. But we really are just going to have to wait till it's published. What we know about it is kind of pieced together from rumors, leaks, other information that's come out over the last month, and it's really just not reliable yet. So I'm going to hold judgment. I'm going to kind of hold off to make any statements about it until we have it in our hands. And to my knowledge, we do not. We don't have that yet. Does anyone in the chat? Has anyone in the chat seen? Wow, chat is blazing. Is blazing. Has anyone seen it? Is anyone aware that it has been published yet at all? I have not. Ooh, my computer is laggity. That's not good. Oh, my browser crashed. That's why. Browser crashed, but it won't stop us. It's not gonna stop us. Hold up. I can't see the chat. There we go. Anybody seen it yet? Anybody heard about any sources having it? Forex Factory 4.5. Yep, no change. No change to the interest rate, but still huge implications, huge stuff coming today. Do not turn that channel. Do not leave. Stay here with the fam. Get wacky. Get weird. I want to see shenanigans. See the shenanigans. There's still more coming today. There is, I promise you. What Chairman Powell says today is going to be extremely important. If you missed the intro, we went all over it. I broke it down. Hopefully I did a great job. Let me know. But we have the crypto presidential 180 crypto review, whatever, coming out today. We have a double header, double whammy. This is a huge day for markets, but an even huger day for Bitcoin. 2 people voted in favor of cuts. I believe that. I think that was true. I believe that was true for the last few meetings. We are likely to get a dot plot update as well. That could be interesting. Tom Crypto Face, love Crypto Face. Shout out to him. I don't know if any YouTubers have jumped in here during this. I probably didn't catch it, but shout out to everybody who's here today. Did a big shout out. Ooh, dollar dumping again. Interesting. We saw Bitcoin, the dollar, and stocks move inversely off of that interest rate published at 2. It's been about 8 minutes. The dust is settling here, and now we are seeing the dollar actually break its lows, break even the correlation that we just saw over the last few minutes here, where very clearly assets were moving up together while the dollar moved down. That reversed. The dollar moved up while assets moved down, and now kind of right back where they began. The dollar hitting fresh lows, at least for this session. Interesting developments here. Interesting developments. Shenanigans. A chirpow. A chirpow. Can I get chirpow in chat? Can I get a chirpow? Chirpow? God, what are we gonna do when they get rid of him? By the way, you want him to resign. I noticed nobody was calling for him to resign today. Like nobody was like, he's gonna resign at the FOMC. What happened, bros? I know a lot of people want to see him gone. Sure, pal, that's right. Yes. But his time is numbered. There is not that many FOMCs left with him. His term is over in May of next year, and extremely unlikely that he will continue on as the chair after that. My only hope is that whoever replaces him is even more entertaining, that it will make even better streams. I don't know. We'll see. Okay, here's what's next. We have 20 minutes until Powell speaks live. 20 minutes. We're going to do something else. We got 20 minutes. This is, and I know there's going to be a lot of confusion as people jump in. They're going to think that this is live. I'm not going to interrupt him every 2 seconds to say this is not live. This is last month's meeting. We're going to listen to it. I'm going to make this a little bigger. We're going to listen to it for subtle changes in language, forward guidance, hints, and we're going to have this fresh in our minds for when Powell speaks in just a little bit to be able to compare them and hopefully read between the lines, is this live? Is it live? Yes, it's live. We're live, baby. That's right. We're going to start this up. It's about 10 minutes. I think it's a little bit less than 10 minutes. But we're gonna listen in. We're gonna be closely. Keep chatting in the chat. I'm gonna chat with you. I'm gonna try not to interrupt. While this goes on, engage with the live stream. Like, subscribe, share it out. Check out the links in the video description below. Sign up with our exchange partners, BYDFI. No KYC. You can sign up anywhere. Jump in our Discord. It's free. And let's see what happened last week. Let's refresh.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. the labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate.
Here we go. This is the important stuff we saw last month. By the way, guys, this is last month. We went over this. We went over this before we put it on, so you can compare it to what he's about to say. This is the dot plot. Each one of these is a voting member of the Fed. As you can see, the Fed is not unanimous in their decision of what they think is going to happen or what they think should happen. If you look here, these dots below, 4%. Currently, our rates are up here. There are 1, 2, 3, 4, 5, 6, 7, 8, 9 members voting for interest rate cuts this year. That's what this shows us. It shows us that as time goes on, they see those rates continuing to go down. We're likely to get an update on this dot plot. Remember what we had here.
Path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy, strategy, and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored.
That's good. That's good. We got through it. So a lot of you 8,000 IQ people out there realized as you tuned in that wasn't live. Well done. You're a sleuth. We were reviewing the previous FOMC statement by request, and because it's useful. We're going to hear him speak live and update us. What we're going to be looking for, to reiterate, is we are going to be looking for differences. We're going to be looking for word choice. Sounds silly, sounds like a game, but it's real. For instance, what are some good ones? Like, confident in disinflation would be a nice dovish statement, a good Cuddy statement. Vigilant on risks, kind of word choice. And what's important also, because these are virtually the same every month, with little exception, what he says is almost word for word. The differences in choice of words can be huge and can move markets. That is why we review it. If you missed the intro, you missed quite possibly some of my best work ever for an FOMC live stream. Quite better. Can we hear the Powell song? Bro, I didn't even play it. That is like a crime. I didn't even play it one time today. Wow, I apologize deeply. Deeply. Yeah, we can play it. Yeah. I want to listen to it. Chairman of the board. By the way, if you go to this channel, type in chairman of the board on shorts. Should find it. Should find it right here. Always available for listening. A chirp out. Put that low in the background. Build the hype. Shut the front door. Yeah. Keeping that money flowing so the economy can grow. Chairman Powell, making paper every hour. Chairman Powell, he got that money power. Hater on his side, watch him rising the power. Yeah, he's the chairman of the board, making moves that empower. Remember the one time I played this and I was dancing, right? At the intro of one of these, and you guys couldn't hear the music, and it was just me dancing. I remember. Tom Brown remembers. Ooh, that was... I still feel that cringe in my joints day to day. We can't hear the music, Tom. Chairman Powell, making paper every hour. Chairman Powell, he got that money power. Hater on his side, watch him rising the power. Yeah, he's the chairman of the board, making moves that empower. Oh yeah. What's up, Aaron Herrick? Jordy94 subscribed. Jant, Malika, Pascal, Rash, Alex, Manguito, Chest Odor, Raymond, Riot, Hamza, Wick, $5 super chat. First guy to stream these FOMCs. Right here. Right here. We invented these. Literally. Go back and check the receipts. We invented this. What's up, Hitcham Manor? Subscribing. Epidemic, Nicholas Perry, Eric Thorne, Arun, and many more. If you're out there and you haven't subscribed, join our fam. Hit that button. We cover these always. Always. What is this channel, bro? I don't even know. Your guess is as good as mine. What are we? Something. Powell the towel. All right, we got 5 minutes. What should we do for 5 minutes? I don't even know what to do for 5 minutes. I got through so much. I'm happy. Nice little inverse head and shoulders. Navigating through the markets, knowing what to do. Federal reserves in control, making moves. Keeping that money flowing so the economy can groove. Chairman Powell, making paper every hour. Chairman Powell, he got that money power. Hater on his side, watch him rising the power. Yeah, he's the chairman of the board, making moves that empower. Oh yeah. Oh yeah. All right, what should we do? We just have like 3 minutes, 4 minutes. Vote on it quick. Did Grok produce this tune? No. This tune was pre-Grok. Richard Hart. Who here loves Richard Hart? If you love Richard Hart, put a heart in the chat. Just chill, yeah, I agree. Run down to the package store. What's up, boys? What's up, Renee? Litecoin chart. Jim says bye, Giga Chad. This is not alive. This is life. Lived. Fed watch tool doesn't look good for next month. Well, next month, to be fair, next month is August, and I don't believe there is an FOMC.
Don't use ChatGPT. Cold sweat smile, open mouth smile.
Wait, plus question mark. What? What? Plus question mark? Chairman Powell actually has been AI the whole time. Oh yeah, I was looking up. The meetings. Yeah, well, I would say, guys, so we know there's no cut this month. I would put next month having a cut at 0% probability. There's a 0%, and I will bet every penny on it that next month there'll be no rate cut because there is no FOMC next month. That would be hard. The rate cuts will only come during these meetings. However, the next meeting in September could be something that could happen, but that'll be in September. I wonder if this is updated already. Nice. I don't know, man. Look at this. Look at this. September 17th. That is a rate cut right there, sirs. 58% chance right now. 58% chance at the moment. According to investing.com. I don't know where they get their data from. But their Fed rate tool monitor. Fed monitor rate tool, whatever. Right here. 60% chance in September. That's why I said not in August. They don't happen in August. And by the way, Mike Nicholson, thanks for the super chat, brother. I'm distracted. 58% chance in September. Right now, that's going to change. But for now, that's the highest percent I think we've seen. The most confidence we've seen. All right, Chair Powell. He got that money power. What is up, guys? You are tuned in. And Chair Powell will be speaking live in just seconds. At this point, just seconds. We are seconds away. Like 90 seconds. Are you ready? I am keeping up the White House articles in the background, refreshing it every few minutes here, checking to see if there has been a release on the crypto 180-day review. So far, nothing. Just very kind of clickbaity titles about stuff. We have seconds to go. You've tuned into the greatest. We got 5,000 live viewers. That's about right. That's about right. Those are right numbers. If you could, I'll do this one more time. Hit that like button. Help promote the stream through your activity, through your hype. Share it out. Subscribe. All these things help YouTube know you're having a good time, and it tells the algorithm to show it to more people. Let's get more people in here. Let's make this poppin'. Put in your silly comments, your shenanigans. Put in your real comments while we're live. I'm going to try not to talk over Chair Powell during his intro. I can't promise about the question and answer part, but we try to make this a good time. Subscribes, likes. Our Discord is free, discord.gg/TomCrown. Check it out. Jump in there. Sign up with any of the links in the video description below. Get some VIP roles. If you're looking for some one-on-one mentoring, check out joincrowncrypto.com. Trying to get one-on-one mentoring with me, myself, Tom Crown. Here we go. Here we go. Give me a sec. No audio feed yet. Yep. They have audio problems regularly. You'd be surprised. Well, that guy's talking. You can tell he's having a good time. I'm going to refresh this to double check. Usually you'll hear the rustling and bustling. Nope, not muted. There we go. Shut up, everybody. Shut up.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet.
Quantitative tightening.
We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks.
Per word.
Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Rock and roll, lock it in. Dollar not liking any
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that
Here we go. Big.
expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
More to come. You heard it here first. Gina.
Hi, Mr. Chairman.
Gina?
Neil Rowan with Axios.
You're not Gina.
This morning
Shut
we
up.
got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on
What
labor,
are these
given the
birds?
fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Dollar pumping now, dollar liking something going on here.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you, and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
Sexy question.
So on the dissents, what you want from everybody, and also from a dissenter, is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table, where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target, That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September, monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be, at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to, slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is, substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean I wouldn't insist upon that. But I don't think I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So There won't be in the end a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria. Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Dollar breaking out. Big day for the dollar.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed.
Dump-a-roon.
And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait-and-see approach is giving...
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
Well, so that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all of the discussion of how they're going to, companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
Reasonable.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Chair Powell is Chair Powell.
Well,
I agree.
So the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, and that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. I mean, we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Chris.
Hi, Chair Powell. Thank you.
Chair
Well,
Powell,
can you give
very
us a
good.
little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But you know, if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So you know, that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? You know, it'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting. Will it be dispositive of that? You know, it's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down closer to 2?
We'll look at everything. You know, it's, as I mentioned, you know, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right so we don't, again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire Jones, Financial Times.
Claire Jones, Financial Times.
Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and how, to what degree that may be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the division of labor between the Fed and the Treasury, as you, I'm sure, know. And you know, the Treasury only speaks to the dollar. It's not something that's been a topic of you know, major discussion at all at the Fed. I won't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question.
Andrew.
I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the U.S. economy? Thank you.
You know, we're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But at the same, we really need the government data. Really is the gold standard in data, and we need it to be, you know, to be good and be able to rely on it. And we're not going to be able to substitute for that, but you know, if we what we need.
Jay O'Brien.
116.2K, interesting.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Tim?
Maria Eloisa.
Yikes.
Afternoon, Chair Powell. Maria Eloisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper-income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing. But so generally, and if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true, and it was again right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this sense, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the 𝐂𝐡𝐚𝐫𝐿 adjustment seriously, it may be even low, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance, oddly enough. You've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that, because of immigration policy, really, the flow into our labor forces is just a great deal slower. And those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the
lack of unanimity in today's decision, the 2 dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So, we have an economic go-around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go-around. All the way around the table, everyone gives their views. So the discussion around policy was, the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. 2 of our members felt that the time had come to cut, and that they, for the reasons that they're going to express. I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. But that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock.
I took a long.
It's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. I said that's why we think policy should be restrictive, is because inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal, so that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Getting sleepy.
Jeff,
Gina. These are good questions.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wonder if you look at that and you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak, and the inflation numbers from GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but GDP is bumpy quarter to quarter, half to half, and often gets revised, after the fact. The labor market data we still think continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation because you're being pulled in two directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not going to say that. No, I just think we're going to need to see the data, and it can go in many different directions. The inflation data and the employment data, and we're going to make a judgment based on all of the data and based on that balance of risks analysis that I mentioned.
Thank you.
All of the data. Every data. All of it. All at once.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
Hey. That's it. The event has now ended. Wow. Well done. You've made it through. What I would say was probably one of the best FOMC streams we've done. If you missed the beginning, check it out. There's a lot of important info, a lot of considerations that played out really well during the stream. We did have the presidential crypto report come out during that live. I didn't have enough time to really dig through it. I threw it into AI, but from what I saw, and I will do my homework here, I didn't see too many specifics, which is what I really was hoping for. We hear from all of the Genius Act, Clarity Act, all these things as kind of repeated over and over again as to provide clarity. We're providing clarity. The issue with providing clarity is you have to provide the clarity. You can't just say provide clarity. That doesn't provide, it doesn't, saying it doesn't do it. I'm not claiming that there isn't clarity in this. I haven't gone through it yet. I just briefed over it. I'm going to do a little more homework, but I didn't see anything quite yet. So give me some time. Give me some time to look into it. I'm not going to cast any judgment. Tone today was hawkish for sure. I think it was more hawkish. I'm still looking towards September for that first cut. I think it's very probable that we get it. We did see a sell-off across markets here on this meeting. Seems to be coming back into alignment. But the real driver here, the dollar breaking out of kind of this falling wedge pattern and moving back to that 100 number here, blasting through some resistance and putting downward pressure, I would say, on almost everything. Ethereum finally entered our long trade, finally hit our long target placed, I want to say on Monday. I took that trade live, fingers crossed for me. My XRP long still live too, but looks a little cooked. I entered, I put a limit order for Pengu coin, I don't know, just some meme coin, that has not filled yet. Here's an update on the trades that we have taken live here recently. XRP, you can still see is underwater a little bit. Ethereum already up about 7%. That was not a bad snag, at least for the moment. I'll keep you guys updated on those trades. We're trading on BYDFI, one of our exchange partners, no KYC. You'll get some big bonuses using my link. So sign up using my link. It's in the video description below. It's pinned in the chat. I appreciate, I think we had almost 6,000 live viewers at one point. Hell yeah, fam. I appreciate you choosing to be here for these meetings. I know you have an option now. Everybody stole their idea. That's fine, but I appreciate each and every one of you. We'll be live again Friday at the latest, maybe even later tonight if things get very spicy. To keep up to date with our live streams, make sure you're subscribed, have notifications enabled. Make sure on your phone for the YouTube app, you have notifications turned on. If you have them silenced, you won't get them. It's weird. You won't get them on your computer or anywhere if they're silenced on your phone. I don't know. It's how YouTube says. Check out joincrowncrypto.com if you're looking for some of that one-on-one. I'm trying to pull it up. one-on-one crypto mentoring. I want to help you succeed. This isn't for everybody. I know it's got a price tag, but it comes with some of my personal time every month while the supply lasts. So check it out. This is a limited time offer. Join crowncrypto.com. Appreciate you guys. I will catch you very soon. Maybe I'll see you in the Discord if you jump in there. Discord.gg/Tom Crown. Love you all. Catch you soon.